Corporate bonds. The wealth game you didn't know you were playing. Imagine walking into a high-stakes casino, but instead of poker chips, the currency of choice is corporate bonds. The players? Multi-billion-dollar companies looking for a cash influx. The prize? Reliable returns and financial security, if you play your cards right. Welcome to the world of corporate bonds, a financial instrument that sits at the heart of the global economy, facilitating growth, investment, and wealth accumulation. Understanding corporate bonds isn't just for the Wall Street elite. It's a critical knowledge area for anyone serious about long-term financial security and strategic investing. The power of the IOU at its core, a corporate bond is an IOU. When a company needs money, whether to expand, buy new equipment, fund research, or even pay dividends, it can do one of two things: issue stock or issue bonds. If you buy stock, you own a slice of the company. If you buy a bond, you're not an owner, you're a lender. The company is legally bound to pay you interest over time and, at the bond's maturity date, return the principal you initially invested. That's the deal. Stocks are flashy, but bonds are the steady hand in the background. If the company takes off, stockholders make a killing. If the company tanks, well, bondholders have the upper hand. That's right. If the company goes bankrupt, bondholders get first dibs on what's left before stockholders see a single cent. It's like being the first person at a buffet. While everyone else is left fighting over crumbs, you get to fill your plate. The good, the bad, and the risky. Before you go throwing your money into bonds, let's talk risk. Not all bonds are created equal, and knowing the difference can mean the difference between a steady income stream and a financial headache. The biggest risk? The dreaded D word, default. If a company can't make its scheduled payments, bondholders can be left out in the cold. That's why credit ratings exist. Bond credit ratings are like financial report cards, issued by agencies like Moody's, S&P, and Fitch. A high-grade rating, AA to BBB, means the company is stable and reliable. A low-grade rating, BB and below, means the company is riskier, but that also means higher interest rates to compensate investors for the extra danger. Bond types. Know your arsenal. Corporate bonds come in different flavors, each with its own unique perks and risks. Knowing your options is key to mastering the game. 1. Short-term, medium-term, long-term bonds. Bonds are categorized based on their maturity, the length of time before the company must pay back your principal. 1. Short-term bonds, less than 3 years, are lower risk, but lower reward. 1. They are favored by investors looking for liquidity and minimal exposure to interest rate fluctuations. 2. Medium-term bonds, 4 to 10 years, offer a balance between risk and return, giving investors decent yields without committing capital for decades. 3. Long-term bonds, over 10 years, can offer higher interest but leave you exposed to more uncertainty, such as inflation and market volatility. 2. Investment grade versus high-yield bonds. 1. Investment-grade bonds, AAA to BBB, are the gold standard. 1. They offer lower interest rates, but they're also more stable. 1. If you want steady, reliable returns with minimal default risk, this is your arena. 2. High-yield bonds, aka junk bonds, pay higher interest, but come with a greater risk of default. 2. These are for those who are willing to take a gamble for potentially higher rewards. 3. Fixed rate versus floating rate bonds. 1. Fixed rate bonds lock in an interest rate, meaning your payments stay the same regardless of market fluctuations. 2. Floating rate bonds adjust their interest rates periodically, usually tied to an index like U.S. Treasury rates. 2. This means if interest rates go up, so do your payments. 4. Zero coupon bonds. Zero coupon bonds don't pay interest regularly. Instead, they're sold at a discount and pay a lump sum at maturity. You might buy one for $800 and get $1,000 back in 5 years. Nice, right? The catch? You still owe taxes on the phantom interest you haven't actually received yet. The bankruptcy battlefield. If a company runs out of money, its creditors line up to claim what's left. Who gets paid first? It all depends on the type of bond you hold. 1. Secured bonds. These are backed by company assets. Think real estate, equipment, or even intellectual property. 1. If the company defaults, secured bondholders can seize those assets to recover their losses. 2. Unsecured bonds, debentures. These have no collateral backing them up. 2. Senior debentures get priority over junior subordinated debentures, but in a bankruptcy scenario, neither is guaranteed a full payout. 2. It's a high-stakes waiting game. And here's the kicker. Bondholders aren't the only creditors in town. Banks, suppliers, pension funds, everyone wants their piece of the pie. Sorting it all out is a messy legal battle that plays out in bankruptcy court. The role of bonds in your investment strategy. If you're serious about financial success, corporate bonds should be on your radar. Here's why. 1. Diversification. Bonds provide balance in an investment portfolio, counteracting the volatility of stocks. 2. Passive income. Bonds generate steady income through interest payments, making them a staple for retirement planning. 3. Capital preservation. Investment-grade bonds help protect capital, making them ideal for risk-averse investors. 4. Tax advantages. Some bonds offer tax benefits, such as municipal bonds that are exempt from federal taxes, allowing investors to keep more of their earnings. 5. Inflation protection. Certain bonds, like Treasury inflation-protected securities, TIPS, offer adjustments based on inflation rates, protecting purchasing power over time. 6. Risk mitigation. During economic downturns, bonds can serve as a safe haven compared to the stock market's volatility, winning the bond game. Corporate bonds aren't as flashy as stocks, but they can be a powerful tool in your financial arsenal. Whether you're looking for steady returns, a hedge against market volatility, or a way to diversify, understanding bonds puts you ahead of the game. So the next time you hear someone talking about investments, remember, the stock market might be the Wild West, but the bond market? That's where the real power players make their moves. The world of corporate bonds is vast and ever-evolving. Understanding how to navigate it effectively can lead to financial stability and growth. By continuously learning about bond structures, market trends, and economic indicators, investors can position themselves for long-term success. Whether you're a beginner or an experienced investor, corporate bonds offer opportunities that, when understood properly, can yield significant rewards.